And we're going to start with one you perhaps may not have been aware of. It's called the total cost of ownership. And this tool is particularly useful when you do life cycle cost analysis, LCA. Okay? And I have a little to talk about LCA later on today as well. Okay? Now, in almost any analysis you do in business, you have to deal with cost. Okay? So I am going to introduce to you a very new way of looking at cost. A cost is not something that you see in a profit and loss statement. It does appear there. Okay? By the time it is already committed cost. What I am looking at is what happens preceding this. In that perspective, a cost is a resource which is sacrificed or foregone to achieve a specific objective. You've heard of opportunity cost, right? If I use the cost for one purpose, then by default I can't use it for anything else. So it is in that sense we are saying that it's a resource which is sacrificed and foregone to achieve a specific objective. It could be a project cost, it could be a product cost, it could be a customer cost, all of which we are discussing next. The next most important thing you should know is what is a cost object. And you may not realize this, but you already know several examples of cost objects. An example of a cost object is a separate measurement for which costs are carried out. The most popular one is a product cost. You need to know how much cost is going into a product, so that if you do cost plus pricing, then you take the cost and you add your margin and it gives you the price, right? That is, in construction industries, that is a very common thing to do. Then what you know for products, you also know for services. What's it going to cost you to provide a service? Okay? Then the third one, you're also perhaps familiar. Any construction project, any project of any kind, you have to accumulate costs, right? Most of the time, multiple years. In fact, there's a whole accounting system called the project accounting system, right? There are assets which are committed, which will take multiple years to expense out. For example, depreciation and all that. Okay. Now, the other unusual cost objects are departmental costs. You want to know what is your departmental cost, use it in transfer pricing, that type of applications. And the other category is more on the customer side, which I'll talk to you about over here. So I'm going to take one company, which is Federal Express. It's a transportation company. Actually, they call themselves the supply chain company. I think they'll be offended if we call them transportation company, because they're doing much more than transportation. So let's take examples of each of these cost objects. One of the most highest expense item for Federal Express is aviation fuel. So you need to know what's the cost of procuring aviation fuel. Another service that they do all the time is in the fleet of planes. They wash their either their planes or their vehicles, right? That is a service cost. Projects would be if they're constructing a new distribution center or a corporate headquarters. That will be an example of a project cost. Now, on the customer side, it's all the cost associated with fulfilling the requirements of an internal customer, which is this example, which we have aircraft operations division. So, what is the cost of serving an internal customer? Now, the external customer, one of the largest customers of this, is what we had seen yesterday, which is LLB. On this, I'd like to introduce to you a concept called customer relationship management. If you remember, I can define this over here. Somewhere buried in the Patagonia case, they were actually trying to compute the customer's lifetime value. What is the lifetime value of a single customer who's pretty loyal? Okay? The customer relationship management nowadays is part of any intelligence packages that are out there. It basically asks the question, what is the cost to serve a customer? And in today's topic of life cycle and TCO, what is the lifetime cost of serving a customer? So what happens is most of the time, customers, so there are two ways in which you incur your costs. Your costs go to serve value and your costs go to incur overhead. And I'm talking about cost to serve customers over here. A simple example of this is the 80-20 rule. Most of the time, very roughly, companies are aware that 20% of their customers bring 80% of the profits. Okay, the rest add to the overhead. So the cost you incur will either add to your bottom line, which is your profits, or it will go to serve overhead. You heard the term that some of the customers are really a drag; they're a pain to deal with, right? That's adding to the overhead, right? So most companies do not have an awareness of what that 80-20 rule is, and this gives us an opportunity and a tool called CRM to be able to do not only who are our profitable customers, who to serve and who not to serve. Okay, even who not to serve is just as important. And the advantage of this is you get a life cycle perspective. So we have a life cycle perspective of which customers to serve, which customers not to serve, and get rid of the ones who add to the overhead and do not bring you profits. Okay, so that's what's happening in this box called the external LLB. One of the largest external customers of LLB. Okay. Now, have you heard of this term called activity-based costing? You will by the time you finish today. Okay. So most of the time we will be dealing with overhead in a minute over here. The true absorption of overhead should be based on a cost driver. You know, so a cost driver is any factor that affects costs. For example, in plain statistics language, you know what's an independent variable and dependent variable, right? Everybody knows that, right? Here the dependent variable is cost and the independent variable will be the cost driver. Okay, if something has a direct influence on cost and you're able to identify that, what happens? A unit increase in the cost driver will result in a unit increase in the cost as well. That's why it's called a cost driver. A change in the cost driver will cause, actually I like that word change, not a unit increase, because although the examples we see in today's lecture are all linear, there can be a non-linear behavior too. Okay, there can be a non-linear behavior between a cost driver and cost as well. Supply chain managers need to be experts in cost managers, and for that we need to be revisit. I don't know how much you know about this, but we need to revisit how cost behaves along with the activity level of the cost driver. And typical activity level would be, I'll just make a simple example. For products, it will be units. And for services, it will be customers. All right, and I will show you the graphs of these 5 scenarios, although some can be collapsed into each other. The first one is fixed cost. If a fixed cost doesn't vary according to the activity level, anything which does not vary according to the activity level, it's fixed, it's a straight line, that's a fixed cost. And variable cost is a linear increase with 1 unit, there's a 1 unit increase, in the independent variable, there's a 1 unit increase in the dependent variable. Mix both, it would be either semi-fixed or semi-variable. So easy way to understand this is through seeing a graph. As you can see, now the vertical axis is cost, the horizontal axis is the activity level, either units for products or number of customers for services. All right. As you can see in the first graph, the costs are invariant to the activity level. That's why it's a straight line. And in the variable cost, it is proportionately increasing. If you take the slope of this, it will be like linearly, it will be a positive slope, right? With 1 unit increase in the independent variable, there's 1 unit increase in the dependent variable, which is cost. Okay. Semi-fixed has a portion which is fixed and there's a portion which is variable, right? Semi-variable is the second, another way to skin the same cat. So it also has that flat portion with the being fixed, and then that linearly increasing portion can is the variable one. Although I have not given you examples of linearly decreasing, that's possible. You can have a negative slope, that it can be linearly decreasing, right? And to complicate things even more further, these need not be linear. It can be curvilinear. Okay, that's why I always tell people to find the empirical distribution of cost. We should plot the data and see, we do fitting, right? Fitting of the curve. So you should check for non-linear curve. All right. So the total cost is the sum of all costs, and all fixed and variable. So total cost increase as the volume of production or services increases, while the cost to produce each unit or each service decreases. And this is called conceptually by the term economies of scale. Economies of scale says that as your activity level increases, your cost per unit keeps coming down. Now, life is not that simple that we would expect that it will continuously decrease forever. Okay? Like you heard the proverb, too many cooks spoil the broth. After some time, there is no efficiency going on in the cook, and the meal is tasteless and whatnot. So, over the time period that the cost per unit starts to increase again, that is called diseconomies of scale. So, the economies of scale is the activity level over which, with increasing activity, the cost per unit goes down. And then diseconomies of scale is the next level of activity level where, with increasing activity, the cost per unit starts to go up. Make sense? Diseconomies and economies of scale. All right. The other thing you need to know, if you remember on the first, in the harvest case, you were calculating break-even point. So this is both for units and customers. You want to know at what volume of sales do you make zero profit, zero loss, which is break-even point, right? The same thing with customers. If you're starting a new service, at what level of services, how many customers do you need for you to break even? No profit, no loss, okay? So this is a simple curve. The activity level is again in the horizontal axis. The dollar cost and dollar sales is on the vertical axis. So you first plot the total revenue curve. As you can see, this is like linearly increasing. Then you plot the total cost curve, which is a mix of fixed costs, because up to this part is the fixed cost, right? Up to this part is the fixed cost, and then comes the variable cost. And this difference between total revenue and total cost is profit. You want this to be as wide as possible. So you have this profit shaded area of profit, okay? So this is true products as well as services. Now, yeah.
Sir, how we will find the cost of a service? So service is being given by a person, by a human resource. So how we will estimate the cost?
I'm getting to it. This next slide will talk to you about that. In order to find this cost services, the first, what is true for products is true for services too, okay? The first, cost accumulation. This is important because especially in these days of having ERPs and software systems, you have to start collecting the costs everywhere from the system. So it's a collection of cost data in an organized way through a cost accounting system. A lot of assumptions are made. Now, would you capture some of the softer costs? Would you capture costs of building supplier relationship or customer relationship? Many companies, will look at it in two ways. If they want to be very minute, they'll try to capture that cost through CRM, through SRM and all that, right? Then, and we'll get to this in the case that I'm going to discuss today as well. But sometimes it's just not worth it. You don't need to skin the cat so thin that you need to get every, minutiae of cost out there. But the starting process, cost accumulation, okay? Then comes cost assignment. If you can trace the accumulated cost or some portion of that to a cost object, that is called the direct cost. Okay? I can do it for all the cost objects, product costing, and you asked the question about services. Same thing about services, first part of that, okay? You can assign it to the services. But some things are not directly assigned to the cost object. We incur an overhead. For example, maintenance and supplies, salaries of people, depreciation and taxes, warehouse rent. All of these are called overheads, right? So the overhead has to be allocated from the accumulated cost, right? So the first portion is direct assignment. The second one is allocation of the overheads, okay? Nearly all systems accumulate actual cost. This is not forecast cost or predicted cost. You should have actually incurred that particular cost, okay? So cost assignment, which is relating to your question about services, cost assignment encompasses both cost tracing, direct object, and cost allocation. The cost tracing is the assigning of direct cost to the chosen cost object, either product, services, project, and so on. And cost allocation is the assigning of the indirect cost to the chosen cost object, okay? So here are some examples of what is considered to be variable overhead and fixed overhead, right? So variable overhead would be things like indirect labor, fringe benefits, services, supplies, utilities. So this may proportionately increase with the volume of activity. But a fixed overhead, whether I produce one unit, or if I don't produce the unit, I don't sell it either, or I sell 1 unit or 100 units, I still have to pay salaries. Okay? That's why it's a fixed overhead. The same thing is true for benefits. Okay? I have to pay the benefit. With the pay comes the benefit. Rent you have to pay regardless, whether if you lease a warehouse or a plant over there, whether you sell a product or not, you still have to pay. Last is taxes. As they say, taxes is as ubiquitous as death, right? Death and taxes. So you cannot avoid taxes wherever you are. So that's a fixed overhead too. Okay? All right. Traditionally, the way you absorbed overhead was you took the overhead cost as a proportion of direct labor. Okay? The first one is labor hours. The second one is direct labor cost. And the third one is machine hour. So when we look at factors of production, so obviously the most common one is labor or machine or equipment. So all those salaries and benefits and taxes and depreciation and all historically were absorbed as a proportion of labor or of, okay? Can you guess why? Why was it done like that? Why was labor or equipment a basis for absorbing? What has salaries got to do with machine hours? Pardon? No, not true. I pay salary regardless. The machine hours can be 0. I still have to pay the salary. If you employ me and I choose not to work on any machine hours, I'm idle, I'm a lazy cat, you still have to pay me. No, we're not talking about that. That's the displacement of that. We're not talking about, you're thinking about how many people to hire versus how many machines to hire. That's a totally different debate. What I am saying is we are incurring these fixed charges, rent, depreciation, salaries, right? How do we absorb that? How do we allocate that overhead? For example, when we bid for, when we do our pricing, how do we absorb that? Somebody's got to bear that price, right? Some customer has to absorb that portion of the overhead, right? Why is it labor and machine? Because it's related to the production of the product. But even materials is related to the production of the product. Why can't I absorb it based on materials? For piece rate. So piece rate is a labor thing. You pay the labor for a piece rate. I'm saying, why is labor the basis for overhead absorption? Or why is machine hours the basis of it? As an asset. Well, there are a lot of things which is an asset. Now that means you will disproportionately give the same value for a productive asset and an unproductive asset, right? First of all, do you see something wrong with this? Is the absorption based on labor and machine hours wrong? How many of you think it's incorrect? It's not a good way of absorbing overhead. How many of you think it's bad? Who thinks it's bad? Is the way, do you understand my question? It's the way you're incurring a salary, right? Not only for the direct employees, for your indirect employees, right? They are working on some jobs which have to be passed on to a customer in terms of pricing, right? So how do I absorb that salary? Is the labor a good way to do that, or machine hour a good way to do that? Okay, I'll give you the answer to this, because it was the simplest thing to do. It was just a convenience factor. These are the factors of production. You know, I take my labor, multiply it by 150%, and that is my overhead. Very convenient to do. But what should it be truly? Activity-based costing. Okay? It should be based on the cost driver. Every overhead should be absorbed based on cost driver, which is what we call as activity-based costing. I'll give you an example of a cost driver and activity-based costing. Tooling. Tooling is a good example of that. In if we do this die shots, the number of die shots you do to each customer order is an activity driver. Okay? If the tooling, or I can do it even more simpler. If a tooling is 100,000 as a 10-year life, I can just divide it by 10, and all the customers that I serve in that 10 years get the same share. But that will still not be activity driver. The activity driver says, today I've used this particular tool and I did this die shot about 20 times. So I take the cost of this tooling and 20 divided by the total number of die shots which is possible times the cost will be assigned to that customer. That is activity-based cost. Okay? It should be based on cost driver and not the convenience of either labor hour, machine hour, or the labor cost. Okay? Did you get the wire harness case that I sent yesterday? Did the class get this case? It's a small one-page handout. No? None of you received it? Did any of you recall receiving this wire harness case? And the second one, I follow up, I send this to. But anyway, I'll give you a brief overview of this, and then I'll switch to the Excel spreadsheet, okay? What we are doing in this case is that we are trying to compare two options. We're doing supplier selection, comparing a domestic option and a foreign option, and foreign supplier. So foreign suppliers from China. We have quantitative data relating to the cost, the price information, volume, lead time, quality, and so on. But we also have qualitative information on coordination, tracking, cultural costs, and so on. Okay? So I want to show you the spreadsheet of this particular case after showing you the case itself. And what we do is when we build the cost, the total cost, we iterate between two columns, either cost per unit column or the total cost column. Okay? And remember that most of the total cost analysis are not exact, but they are based on reasonable assumptions. Okay? My laptop is too far away. The domestic option is really simple. Okay? Now, if I take any global sourcing situation, what happens is that you have a supplier plant here in China, okay, and the plant ships its product to a distribution center. From the distribution center, it goes to a Chinese port. From the Chinese port, we have the ocean-bound freight, and we have all the ocean-bound costs, and it comes to the US port. Then there is an inland transportation. It goes to the buyer DC, and then it goes to the buyer plant. Typical supply chain. Okay? What I want to impress upon you is that the total landed cost adds value once this value-added activities are incurred. For instance, when you go to the port, they charge some fees. When you go to the US port, they charge some fees. There's customs clearing, brokerage. You know, everywhere there is some charge being levied for this. And so when you look at the product value, it starts to increase. So when it started at a plant, just as a hypothetical example, it started at $5 per unit. Once it went to the distribution center, it has been, value has been added because it is closer to the customer now by one stage. Okay, so I'm saying it's $5.15 now. Now it goes to the port. It's 2 stages away from the source and a couple of stages closer to the destination. So $5.20 come to the US port. It has gone from $5 to $5.30. So added value of 30 cents. Okay, and then to the buyer distribution center $5.45. That means when it comes to the plant, there is a net added value of $1 from 5 to 6. Does that make sense? This is the value added. So the product value is increasing as it goes from the supplier to the customer. Okay? So with that in mind, I want to show you the case because it gives you all different types of cost drivers that we were just talking about. We are trying to source a wire harness. It can be sourced from 2 locations. One is a domestic port. The supplier is in Michigan, and then the other supplier, the foreign source, is in China. Okay? The first information that you collect when you do landed cost and or total cost of ownership, estimated demand. And you will see in the spreadsheet, this is an important variable to find the 2 columns of total cost and cost per unit. So the estimated demand is 6,000 units per month. So 6,000 units per month is 72,000 units per year. Because if you remember, the total cost is going to be collected by year. The second thing, so by the way, I'm going to start collecting the drivers now, the cost drivers. The first one based on this information is the demand level could be a cost driver. So for instance, safety stock. If you say I want to have 4 months demand as my safety stock or my buffer stock, that's a cost driver. Okay? The second thing that we are told is the volume occupied by 1 unit of the harness. 24 inches by 12 inches times 6 inches is actually 1,728 cubic inches, which is 1 cubic foot. Okay? So estimated demand is this. Volume occupied by 1 unit is actually 1 cubic foot. So the second driver is volume. Third thing is that you want to know the weight. 1 unit weighs 10 pounds. So this is also a cost driver, because some of the costs are levied based on the weight. Okay? So we are told that 1 unit weighs 10 pounds. Alright? So could you please go up a little on this? Go up the slide a little. No, up. Okay. The domestic quote is very simple. The unit price, packaging, and tooling. Tooling, you can see, is a fixed cost. And then freight is per 100 pounds. Okay? We've already written the weight. So the freight that the trucking company will charge is $2.50 per 100 pounds. But this case is all about the landed cost of the foreign source. So let's go to the foreign source. Okay? So here we have this quote coming from this Happy Lucky Assemblies. The supplier must pack the harness in a container and ship via inland transportation to the port of Shanghai, and then transfer it by ship to Los Angeles, and then have the material transported to Chicago. So we have unit price, shipping lead time. Shipping lead time is 8 weeks now. So now we see lead time as a cost driver as well. So there are some costs which are incurred based on the shipping lead time. Okay? Now, each month there's monthly shipments. Okay? So here we have one more activity driver, which is shipments, number of shipments. If there is monthly shipments, that means in a year we have 12. Make sense? And each month you'll be sending 3 40-foot containers. Okay? So the number of containers is also cost driver. you please go down? Okay. Packing cost is a fixed cost. Cost of inland transportation is $200 per container. Check. That driver is put in place per container. Okay. Then look at the other one. Freight forwards is $100 per shipment, the number of shipments. So here's an example of that cost driver. The cost of ocean transportation, is also on a per container basis. So we have one more cost like that. Okay. Marine insurance. Okay. Now, most of the insurance is based on cost or market value, whichever is lower. So what you will see in the spreadsheet is that I put another column to indicate the value of that particular shipment. So the first time that we are seeing that it is called, by the way, the technical term for this is called ad valorem. It's a Latin term to indicate that the charge is based on the value of that material till product till that time. So you're saying that okay, port handling we did container, right? Customs duty, 5% of the unit cost. Okay, what is the total cost till that particular time, and 5% of that is like a ad valorem cost. Okay, one more, customers broker fees also based on shipment. So we have one more like that. Transportation cost now is based on weight. Okay. And now the next one, warehousing charge, is to keep 4 weeks of inventory in the warehouse along with that lead time of 6 weeks. Okay. So about 10 weeks of total inventory. Now this is based on cubic foot per month, which is volume. So it is charged on the basis of cubic foot per month. Okay. Then corporate cost of capital, holding cost is 15% also on the cost. Okay. And I have a separate tip sheet for you to look at the calculations over here. Cost of hedging currencies is also $400 per shipment. All right. Additional administrative time is also on basis of shipment. All right. And then this is a fixed cost. All the cost of coordination and all that is the fixed cost. Okay. All right. So the question is that, okay, can you move up a little bit? So the question is, so we want to find the total cost per unit for the domestic source and the foreign source. Okay. The main thing to do, I'll quickly show you the spreadsheet. I'm going to provide access to this spreadsheet for you folks too, for you to take a look at it. The math in the spreadsheet is not that difficult to follow, because you could go to the cell and see how it's calculated and all that. But what is hidden into this, the conceptual principles, is that these costs which are being incurred for any shipment today in the planet, whether you go from India to Japan or you go from China to the US, you are incurring, in fact, this is not entire, this is still a textbook case. There are a lot of other costs you're going to incur and so on. But this is the way you get total landed costs. Okay? And these are the drivers to that particular cost. So let me show you the spreadsheet in a minute. I just want to give you a very excuse me, a broad overview of this spreadsheet. We're not going to go through everything line by line. A couple of things to point out. The first thing is the annual cost. Okay, in this particular test case, the demand was 5,000, not 6,000. So that's why 60,000. So in this case of the case, it was actually 60,000. So you have two columns. You can come down a little. Okay, say two columns. The 60,000 is the total cost, annual cost, and the per unit cost. And as I mentioned to you, sometimes it's easier to fill this column, like unit cost, it's easier to fill this column, and then you multiply it by 60,000 to get that one. Another one is packaging. An example of how you do the reverse is for tooling, you enter the number here, and then you get the per unit cost. Okay? So the domestic cost is 3137, and in a year it is 188, 1,882,200. Okay, so let's go to the Chinese code. The only thing I want to show you here that it goes through line by line all the items in the case, but I've added one more column. There it is. Okay, one more column. You remember the chart I showed you, the added value from one point to the other, right? We are accumulating all the costs till this particular stage, till marine insurance. We are adding this over here because we can use that for add value. Okay, that in gist is the spreadsheet. Okay, and I'll give you copies of that. If you go down a little bit, you can see the total cost down, please. You see the total cost for the foreign source, and then you see the total annual cost for that. In this case, the domestic sourcing is cheaper by $1.31. Okay, gives you an example of the cost. Can we go back to the presentation? The taxes could be one thing which could be included too. Yeah. In this case, it was not because it's just a hypothetical case. I think it takes the form of customs duty and all the other things. Yeah, this is the one. Okay. In the spreadsheet, do you have any questions on the wire harness case? All right. Now I'll give you another case study of total cost of ownership. Now in a services case, okay, which is the Bank of America case study. How they use total cost of ownership. Okay. We haven't yet defined it. We just know total cost of ownership is being landed cost, but it's much beyond landed cost. So it's the net present value of all costs associated with a product, service, or capital in equipment incurred over the lifetime of the product. Okay, so in fact, one other popular applications of TCO is in software equipment. They use TCO tools. So typically, we tend to look only at purchase price. So buying a car, you want to buy a nice, reliable car, and you look at the purchase price. But what about the maintenance cost? What about the lifetime of that particular cost? You know, what are the gas mileage? You have to take all the post-acquisition costs into account, right? Then the cost of acquiring, sourcing, administration, in wire harness, we just saw this, freight and taxes and so on. Usage costs, converting from one option to the other, inventory costs, warranty cost, installation cost, training cost, downtime, opportunity cost. I bought one equipment, I could have bought something else, so there is an opportunity cost of that. And finally, the reason we are discussing this tool over here, the application to LCA, is the end of life cost. The cost incurred when product reaches the end of life, less the salvage value, disposable cost, cleanup cost, project termination cost, and so on. So the case details was like this. This is a bank, it's a service company, right? And they were trying to consolidate and leverage major spend items to, reduce the cost and improve the profitability of the bank. So they identified all the commodity family baskets, and the one in question for this case is document management, the amount of money they spend in forms and documents for the bank and so on, and how they use that particular case study to drive down the cost. What they were doing is when they looked at document management, they were also looking at the printing option, desktop printing, multifunctional copiers, network printing, and so on. And there was no team to manage the total cost of printing and copying, which made understanding the desktop environment really impossible to figure out whether it was costly or not. And there were no metrics in place to understand the total cost of the desktop system. Although they were having this copiers which just were not only printing stuff or copying stuff, it could fax stuff. They were not using the multifunctional copier effectively at all. So 95% of them were still using multifunctional copiers only for manual copies. Okay, and most printings were done on unregulated desktop printers. So imagine if you have a client server environment and you're sending jobs to a network thing, it can get recorded because you log in, your username is there, everybody knows who's printing what, right? So you have a way of documenting who's printing what. But if I'm printing it to my local machine, nobody knows, right? That's what we were talking about. We are unregulated desktop printers. Okay, so the solution they came about is, it's interesting when I come with the feedback, I tell you this, that demand management, which we talked about yesterday, forecasting, is something we see in a product environment. What is a bank doing with the demand management? So now you can see that now a print job could be a unit that you can forecast. What is going to be a demand for a print job from the different users in a bank, right? So they approached the required demand management and did a little bit of re-engineering. They created a document management team which formed a digital library of all the forms that the bank were using over the lifetime, okay, which also increased cost savings to reduce printing costs and centralization, and basically a shift from traditional printing to client-side desktop delivery, so that you can capture that. And you can see this client-side, like a terminal-side services client and a centralized server over here, which was part of the technological solution that they did to track who's printing what and when. Okay, so this entire document management was then divided into 6 functional groups, each with a different purpose. The first one had to do with digitization. The second one had to do with optimization of mail delivery. The third one, print start, was what I just showed you, the centralized responsibility for desktop environment. Then you had commercial print, reprographics, and records management, because banks have to keep records for a certain time according to law before they can destroy it. Okay. So these 6 groups fit under one umbrella strategy. They wanted to be lean. Okay, but lean we have studied only from a product point of view. What is lean for document management? That's what we'll see in this case. So they wanted a change control engine which would standardize all the images and make one database for all this image library. It will control the distribution of jobs. Okay, who goes first, who goes next, and so on. And it will also take a look at end of life, what's happening. And if I commit to something now, I am obviously incurring a risk. So I want to kind of mitigate that particular risk. And then metadata data capture, updates to their software, and doing end-to-end view. Although the case is based on one branch in the bank, they could roll it out to multiple banks and get that end-to-end metadata view. Okay. Else was they created large digital database that required every new document to be scanned and it could be accessed with ease. And the new demand standardized documents. They also were able to consolidate their printer suppliers and reduce their print cost by 20% year after year. I'll show reduction in obsolete documents, and they reduced the obsolete documents, reduced inventory levels also by 20%. Okay, drastically cut amount of printouts. If the printout was, the cheapest one would be to send it to a network printer. After some time, they were able to reduce the investment of paper held on site. So they can even plan for, even though it's a document and we're thinking of a digitized library, you can also plan for the forms and the papers, the paper on which the form is printed. Okay? And for the copiers, you could plan your predictive scheduled preventive maintenance, either predictive maintenance or preventive maintenance, same thing, right? At what time? So when there's a lull and there are not too many print jobs going on, that time you schedule your maintenance of your copiers, track missing paper inventory and so on. So you get a lot of benefits by just going through the demand management, the digitization, and some re-engineering of their particular network. But it wasn't easy because people seldom change. So there was a culture shock. They did not want to change. They did not want to go to walk to a universal printer 20 feet away, but would prefer to print at their desktop. Okay? Implemented at corporate offices to show that now this case study, which is interesting, is actually implemented in the worldwide corporate headquarters of Bank of America. They said if I want my branch to change, I have to change first. So the first test site was actually at the corporate level. Okay. So the feedback points from this case is multiple. It is very unlikely. I'm curious to see that if in India, if you walk into a bank, you ask them, do you have a supply chain division? They may probably roll their eyes and say, what is that? Okay. But here they're saying that financial service companies also seem to have a supply chain function within the company. When I was curious as to what they did, this is what they did. Now, every function develops a strategic plan, so this is a no-brainer. But they also had supplier scorecards. They're reviewing total spend by commodity, and they were looking at a consistent approach for sourcing each commodity, which all product companies do the same thing too. So there was some benefits. Okay. Now this is the most important part of the case. It's not very obvious. We are quite familiar with the product environment. What do we do in the product environment? So when we build the product design, we build CAD/CAM prototypes. We think about product life cycle. We think about specification of the end product, specification of the part. When we want to make change because of customer changes, we have a formalized process called ECO, Engineered Change Order. Not anybody can change the specifications at their will. It has to be a formal process, and that's called ECO, okay, with a lot of high-level sign-offs and all that. Then we have standardization of design. So if the designs are standardized, we can cut cost, the lead time goes down, the experience curve goes up, and if we standardize parts, the same thing. We get a lot of benefits. We can build a total cost of inventory down. But in the end, it is not standardization of parts alone which will work. I should reduce, Patagonia will be happy with this. I should reduce the number of parts which goes into a product, parts reduction. I should do that, right? Now, the interesting thing is to compare this to a document, which you never think about, okay? Document also has, like a CAD/CAM prototype, it has a digital library. All the documents are part of the digital library. There is a life cycle focus to a document. A document is created, it is born, it grows, you keep using it, it grows, it matures, and it decays and dies, after which it is digitized, right? These are the stages of product life cycle, right? Introduction, growth, maturity, decline, and decay or death, right? So we never think of a form to have a life cycle focus, okay? Specifications of document, just as parts have specifications, your form will have specifications, A4, A3, all the different sizes of the form. Disciplined change control. If I didn't like pink, one form is being printed in pink, I can't go around and just change it overnight. There's got to be a disciplined change control, okay? How many fields go into that particular form? This is all very excessively negotiated amongst groups. People will want to bring in additional fields which are necessary for their job, right? So there should be a high-level sign-off in terms of the disciplined change control process. So just like you have standardization of design, you have standardization of document, just like you have parts reduction, in the end, you have to reduce the number of forms. Does that make sense? So there is a parallel between the new product environment and the document management environment. So they did this re-engineering changes to say that the number of delivery channels for the print job were reduced to 2, network and multifunctional device, that should be preferred printing job, and desktop only in exceptional cases. The demand management function paid off in many ways, because now you would be able to route all the print requests to a multifunctional copier, and exceptions would be to the desktop. But it was interesting, they contracted with their printer supplier to not buy the equipment, but to lease it. They leased the printers. And here's another example of the active costing. The amount that you paid was not a fixed amount. The amount you paid for your printer was based on a per impression basis. That is rather unique, isn't it? It's very hard to track it. I don't know how they tracked it. Like with every print, number of impressions rolling as a counter, you add that all and you get on a per impression basis charged, and the supplier gets paid. But so they went from outright purchase to a lease option, and not a fixed lease option, but on a per impression basis. Okay. It also facilitated tracking of number of copies for forecasting, reduced paper inventory investment, facilitated maintenance schedules, but also was able to do ABC analysis. Do you know what is ABC analysis? ABC analysis is classifying it on most important, the next important, and the least important. Okay. In this particular case, they were trying to take a look at usage volume. A category in this is which form is being printed the most. B is the medium and C is the least. Okay, so they were able to track all this kind of information. And from a cultural change, I was giving you examples of other companies that we have consulted with in the US. It is very difficult to shut off options. So there's a utility company in South Carolina where we had, and for the linemen who were one of the highest paid people because it's a very risky job, just changing some brands of Gatorade ended up in a big revolt. So, okay, rather than fight you guys, we'll give you all 6 brands of it. So it's very hard to shut off options. Shutting off channels was very difficult as well. By the way, a very common thing which is common to these 2 points is about shutting off channels. Most things have 2 options, which is centralized and decentralized. So in our Bank of America case, it was whether you have a centralized network printer or you have a desktop printer, right? Now, these 2 sets of strategies, which we call structural strategies, works across the supply chain, purchasing, even to a certain extent manufacturing, then logistics, and retailing. The centralized strategy, the headquarters or the top purchasing function makes the decisions for all the purchasing. Okay? For manufacturing, you'll have one large plant versus several small plants. Logistics, in fact, the formal term is called centralized distribution center, and if it is decentralized, it's called regional distribution center. Retailers, whether you want large retailers or small retailers, all of these have a common thread that the choice is whether when we centralize, we have few, and when we decentralize, we have many, but the size goes down. Okay, so that is the common thing which was happening in purchasing. Should we have a centralized strategy or decentralized strategy, and a shift from decentralized to centralized, and vice versa. This particular company is a plumbing company, and they said we're going to bring everything to the headquarters, not have so many locations for this plumbing supply. So the implementation of change, as I told you, pilot was in the headquarters, follow up in other locations. They started tracking all kinds of new metrics. Print cost was reduced. Connectivity to multifunctional devices was increased. So in that sense, with that metric, we were able to see the improvement and so on. The contracts were converted into a cost per impression basis. I just talked. It turns out the least cost option is a multifunctional device, which is 2 to 3 cents per print job. And the most expensive option was obviously desktop, which is 8 to 12 cents per print job, almost 4 times, right? So they adopted the total cost of ownership principles, looked at lifetime assessment, and from the contract management point of view, they did a clever thing. They told them the supplier should renew technology every 3 years. Okay, so that is the main reason we are going to go with you. If I work with you, you should give us a free upgrade in the technology every 3 years. Not really free, but option to use that particular technology every 3 years. Okay. Now we are finally. Actually, I have another case study to show on TCO, but I wait till we have time on that. Okay. Any questions on TCO? Okay, how are we doing on time? Do you need a break or it's what? 11? Okay, let's take a break. We'll come back and look at ISO 14000. We'll look at corporate greenhouse gas accounting and a little bit of LCA. Okay.